Hi guys, welcome back to the Blockkoin Trading Academy. So today we'll be doing lesson number 8. In the previous lesson we covered stop loss placement as well as invalidation. Today lesson 8 is more about covering liquidity and why price often moves beyond those levels before reversing. So if you've ever been stopped out and then watched price move directly into your original target or your take profit and you don't know why, this lesson will explain it. So starting off with step number 1, what is liquidity? Liquidity is where large clusters of stop losses sit in the market. So it will either sit in one of two places, either above resistance, where stop losses from short traders sit, or below support, where stop losses from long traders sit. So as you can see, I have Bitcoin on the 1 hour chart with a bullish flag over here. As you can see, we're starting with support to resistance to support to resistance to support, and now currently at resistance once again. So with these levels over here, resistance and support, liquidity will mainly lie just above it, just above resistance, and like I said, just below support. This is where most stop losses are, so this is where the market is more drawn towards, so that it can reverse and that it has enough liquidity and buying power over here to push up, or enough selling power to push down. Moving on to step 2, why price hunts liquidity? So markets first of all need volume to move. Stop losses create automatic market orders, right? Automatic market orders. So when price moves above resistance, like this over here, short stops trigger, meaning your sell stops trigger, which creates buying pressure. And vice versa, when price moves below support, long stops trigger, creating selling pressure. So as you can see this wick over here, I'll just take this one for example. It wicked above, did not close above resistance, just wicked above it actually 3 different times, and then reverse down. This is a clear indication of a sell grab or a stop loss grab or a liquidity grab, right? This is not manipulation. This is just how markets function on a day-to-day basis. That's what you need to understand. This isn't the markets against you, against your strategy, or the markets out to get you. This is just how the markets move on a daily basis. So this brings us closer to step 3, which is liquidity versus breakout. Not every move above resistance is a breakout. Sometimes price moves beyond the level, like over this over here, only to collect liquidity, then to reverse. So like I said with this example, as well as this example, price pushes up, collects stop losses over here, creating liquidity or getting liquidity, and reverses down. Whereas with a breakout would break above this resistance, close above it, perhaps push down to retest it as support, and then push up. That would be a confirmed breakout. When price just comes out and immediately reverses back into the range, that is just a liquidity grab. Step 4, how to avoid getting trapped, right? So first of all, do not place your stop losses exactly at the obvious levels where most people would place their stop losses, right? Because then you just end up becoming that liquidity. So instead of placing a stop loss there or at support, place it beyond structural invalidation. Wait for confirmation before entering trades or entering a reverse or breakout trade. So I'll just show you exactly what I mean by that. So if I take the long position over here, most people would perhaps enter immediately off of this trend line over here, have a small stop loss and target that over there. But that is not structurally correct because there is nothing that tells us that price shouldn't come over here. So in the ideal setting, you are actually placing it below the previous higher low, because we are in a bullish formation, so we use higher lows, right? And then you are targeting resistance, of course, over there, or if you do have a bit more technical skill, those highs over there I do have marked out because I would like to see that targets reached. So I would actually place my target over there. But that is just my thoughts. That is just the way I would like my trade to play out, not any financial advice. So yes, place your stop losses where invalidation, beyond structural invalidation, and not just where you'd like to keep it, or just because you don't want to risk as much, or just to keep the risk reward high enough. Always place it with structural validation, right? Moving on, or beforehand, so understand that knowing where to place your stop loss or understanding liquidity will help you actually place your stop losses much better. So because you understand that price needs to tap into certain liquidity, grab certain liquidity, or break through certain liquidity in order for you to place your stop loss in a valid point. Moving on into step 5, just like in every lesson, we will be talking about the professional mindset. So understand that liquidity is never your enemy. It is strictly just information. So before you enter a trade, ask yourself, where are the obvious stops? Is price likely to sweep them, as in grab them for liquidity? Or is prices most likely not going to tap that area because it would overall change the structure of the market? So markets move towards liquidity. You can take this from the lesson. Markets move towards liquidity. Structure tells you direction, and liquidity tells you where price may visit first. That is all for lesson number 8 today, guys. I hope you enjoyed it. Next lesson we'll be covering time frames and how to align multiple time frames properly. And as always protect capital first. Growth comes after. Thanks, guys. I'll see you in the next one.